Hello, my name is Tiffany C. Wright, and today I'm here to talk to you about what bonding companies seek in a balance sheet. And this is part 2 in the relationship between bonding and finance. And as with part 1, this presentation is targeted at construction companies. Other things that bonding companies look at to determine a bonding program are the list of jobs on hand and the year in perspective. What does that mean? Well, the questions are like this. Does the company average jobs of 200,000 to 300,000, but occasionally garner projects of 1.5 million? Is there a large job that's scheduled to commence in a couple of months? Assuming the larger projects are also fully bonded, the bonding program should reflect this pattern. Otherwise, the construction company would have insufficient bonding capacity on a per project basis to cover their larger projects. Consequently, bonding agents, that is, bonding company, bonding agents, this is not like super glue. Okay, anyways. Bonding agents look at the spectrum of jobs performed and anticipated for the year and those from the previous year. They also look at the contract value of each job and the length of each job. Bonding companies seek a 3-to-1 debt ratio on the balance sheet. So that is your debt to assets or your debt to assets and equity. So if you have 500,000 in debt, they will want you to have at least $1.5 million in equity and assets. Therefore, whatever you can do to decrease your debt will improve your ratio. As stated previously, you or an investor or partner can inject equity capital. That was stated in part 1. You can pay off a term loan. You can restructure existing loans. However, bonding companies can tailor the bonding program to fit the balance sheet. If all your jobs are fully bonded, this could pose a problem. If only some of your projects are bonded, the tailored bonding program may meet your needs. If you are having difficulty obtaining bonds, you have a couple of different options. One is an SBA guaranteed bond. An SBA guaranteed bond works similar to an SBA loan. SBA loans are not provided directly by the SBA. They are provided by banks, and then the SBA guarantees payment of what I think it's typically 80%, sometimes as high as 90%, but typically 80% of the loan in the event that the owner, the business owner, or the business defaults on the loan. So an SBA guaranteed bond works the same way. There's also third-party indemnities. These can be provided by the seller of a company if you are buying a company, by an investor, or by a joint venture or other partner. So in the event of the seller providing a third-party indemnity, if you're company A and you're buying company B, so you're buying company B and it has $5 million in revenue, and 4 of those contracts for $3 million are bonded. Well, now that you're taking over the company and taking over the bond, to ensure that the bond stays on the books and stays in place, you would need the seller to provide you with a third-party indemnity. Bonding companies strongly prefer reviewed financials. Of course, if they can get audited financials, that is the strongest preference. But bonding companies understand that the cost difference between audited and reviewed financials is significant, often several $1,000s. For a long-term customer, bonding companies may take CPA-compiled statements. Why is that? Well, as I said in part 1, when companies are bonded, they typically have a line of credit with the bank, and often a bank requires monthly reporting for the purpose of monitoring that line of credit. So that makes the bonding company feel more comfortable when they have a long-term relationship with you. However, when that customer seeks more steady bonding or aggressive bonding or presents a weaker balance sheet, the bonding company will want to switch to reviewed financials. With reviewed financials, the bonding company can be certain that the financials presented to them are accurate and reflective of the company's true condition. Why audited or reviewed financial statements? Well, with QuickBooks only data, a company's owner or CFO could add false data, delete information, or manipulate timing to make their financial statements look better. Or they may simply make mistakes due to unfamiliarity with generally accepted accounting principles, also known as GAAP. With no credible external source, a CPA, which is a certified public accountant, reviewing the information, the bonding company cannot be certain. CPAs and CPA firms and their accounting activities are regulated. Private company owners and CFOs are not. Of course, outright fraud is always illegal, but can be difficult to prove unless it's glaring. Most bonding companies like personal guarantees or other guarantees to 100% of the bond. Hey, if they can get it, why not? Not to say that they won't take less than 100%, but that's what they like. Remember, bonding is not insurance. Bonding is much less of a risk product than it is a financial product. Bonding's purpose is to ensure that the project continues with minimal hiccups as smoothly as possible. In the rare instance that the bond is called upon to pay, the bonding company expects full reimbursement of their payouts up to the bond limit. So the bonding company will pay the bond when necessary, but they will come back to you to get fully reimbursed for that payment. That is definitely not like insurance. In general practice, if the bond company must pay out to the extent that it was their customer's fault through overt negligence or fraud, the bond company will pursue full repayment. Repeat, to the extent that it was their customer's fault through overt negligence or fraud, the bond company will pursue full repayment. To the extent that it was not their customer's fault and the customer helps them as much as possible to mitigate the payouts, the bond company will pursue only partial repayment. I repeat, to the extent that it was not their customer's fault and the customer helps them as much as possible to mitigate the payouts, the bond company will pursue only partial repayment. For additional information on lines of credit or other financing sources to help your business, check out my book, Solving the Capital Equation, Financing Solutions for Small Businesses, available on Amazon. You can read the testimonials there. Thank you very much. You can follow my blog at www.cashforimpact.com. And again, I'm Tiffany C. Wright, your resourceful CEO.